Is it possible to retire with a £100,000 pension pot? While £100,000 seems like a large sum of money, whether it's enough to retire on is an entirely different question. The answer to this is going to depend on a number of assumptions. But in this video, I'm going to do my best to paint a picture of what a £100,000 pension pot can provide you in retirement, so that you can make the decisions for yourself of whether or not you can retire on 100 grand. So let's discuss our assumptions before we dive into things here. We're going to assume an age of 67 and a mortality age of 90. We're also going to assume that the £100,000 is held in a defined contribution pension pot and that we will be entitled to the full state pension. So an interesting place to start here is with annuity rates. Currently, the best annuity rate is £7,196 for a £100,000 pension pot. But this does not include any lump sum and stops as soon as you die with no payout for spouses or civil partners. Also, it stays fixed at this level for the rest of your life. And we know that inflation is going to mean that your spending will increase over time, and this annuity payment will not rise in line with that. If we factor in our state pension, which currently sits at £11,502, we can expect an income of £18,698 for our first year of retirement, which will partly increase in line with inflation due to the triple lock on the state pension, but the value of this annuity will steadily decrease over the years as the buying power is eroded by inflation. So plugging this into our cash flow modelling system, assuming our state pension rises with inflation and the annuity does not, our spending capacity in retirement averages out to be around £16,611 annually, and this factors in taxes. You can see that our income by the time we hit 89 is at 29.2k due to the predicted state pension increases, which is an interesting point of comparison when we look at what sort of income we could achieve when we choose a drawdown approach instead of an annuity purchase. So let's take a look at that now. So all we're doing here is removing the annuity annual income from our cash flow model and replacing it with the £100,000 defined contribution pension asset and keeping our state pension consistent. Growth rates on pension portfolios for people in their 60s approaching retirement averages somewhere between 4 and 7% due to the de-risking by removing equities and investing more heavily into lower risk profile assets such as bonds and cash holdings. So we've assumed a 5.5% annual growth rate with a 0.5% fee for a 5% net annual growth on the plan. When we run the retirement spending power model now, we have a £17,134 annual spending capacity in retirement, or about a 3% increase compared to the annuity option. The reason here is simply being that our pension pot continues to see growth in line or above inflation throughout the period, whereas the annuity was degraded slowly by inflation. Remember, both of these values are spending power, not totals, so they have the impact of inflation inherently baked into them. What's important to consider here is that the drawdown approach may have had a slightly higher annual spending power, but it's subject to a fair few assumptions. And in reality, there is no chance that such a straight line and consistent level of growth will be achieved. There's far more likelihood of a more volatile level of returns, even in a low-risk portfolio like we're modelling here. On the other hand, the annuity model is pretty set in stone. Despite it not rising in line with inflation, this is what you will be receiving income-wise. And barring any changes to the state pension system between now and the mortality age, this is a really reliable model to base expected income on. There is, however, one assumption that is baked into the annuities that often is omitted when running through these models, and that is the assumption that you live until the age of 90. Remember, this annuity contract had no payout upon death. So you're effectively banking on the fact that you live to an age which makes this annuity worthwhile. This is one of the big drawbacks of annuities compared to flexible drawdown approaches. With drawdowns, if God forbid your health deteriorated to the point that you knew that you likely had less time, you could increase your drawdowns in those remaining years, whereas an annuity you're stuck with. As well as this, if you did pass away more suddenly, your pension pot would be inherited by a spouse or whoever you specify in a will, whereas the annuity would simply stop paying out. It's worth noting as well that this isn't always the case with annuities, but as soon as you purchase one with, say, death payout benefits or that do increase in line with inflation, the base income you receive from it will inherently be less.
There are lots of things to consider when choosing a pension annuity. For example, you can choose between a lifetime annuity, which promises a guaranteed income for the rest of your life, or a temporary annuity, which guarantees an income for a fixed number of years. If your life expectancy is quite low, for example because you've suffered from ill health, you may be eligible for an enhanced annuity, which usually means you'll get a higher income. Finally, you can decide whether you want an escalating annuity, where your income goes up each year based on either a fixed percentage or inflation. As well as the type of annuity you choose, the annuity income you'll get depends on things like your age, health, and where you live. Generally, the older you are, the higher the income rates you'll be offered. As with pension withdrawals, the payments you receive from an annuity are subject to income tax. Usually, your annuity provider will deduct the tax for you.
So we've established that with a 100k pension pot, and assuming we live for 23 years with a full state pension, we can expect a post-tax disposable spending power throughout retirement of around £17,000. But how does this translate to living standards? Because I appreciate giving spending power as a figure can be a little bit convoluted. To be clear first, this will mean that what you are likely to have is the equivalent to what £17,000 worth of money could buy you in today's economic climate. So that's the sort of spending power you'd be looking at. The Pensions and Lifetime Saving Association performed a study where they examined what would provide a minimum, moderate and comfortable level of retirement income. And as you can see here, 14.4k a year is what is needed according to them to cover a minimum lifestyle need in retirement. To be clear, this does not mean it's simply what's needed to survive. More so a humble but standard life, including one holiday a year, moderate spending on gifts, etc. I don't love studies like these, but in cases like this, it's a reassuring one to look at just to know that a decent standard of living could be maintained on what you have. Realistically, you should look at your own typical expenditure and future anticipated spending needs when deciding whether this provides a comfortable living income, as this is subject to a huge level of variance based on lifestyle. What can be said here with near certainty is that a pension pot of 100 grand isn't going to provide you with an exceptionally high level of income throughout retirement. Assuming no other income sources apart from this and the state pension, you're looking at a retirement income that is modest and livable, but probably on the lower end of the spectrum from my experience. There are, however, a number of ways to increase this, if you know that this is a level of income that isn't likely to facilitate the kind of lifestyle you want and need in retirement. Things like delaying your retirement by a few years or seeking some sort of side income to bolster your annual take-home pay that will inherently reduce the amount that you need to draw down from your pension will have a cascade of positive effects on your retirement income over your lifetime, in addition to just increasing your overall income at surface level. Most notably, it allows your pension pot to be exposed to growth at a higher base amount for a longer period of time without you reducing that base level of money to gain returns on, which will provide more tax-free compounding growth for you to eventually draw down from. I recently made a video on some ways that you can increase your pension pot's value without directly contributing more to it in the video linked here. So I'd recommend giving it a watch if it's something you're interested in. Anyway, I hope you found this video helpful. If you did, please consider leaving a like and I'll see you all in the next one.